Stock and bond investors are experiencing more frequent anxiety attacks as the time grows near for Trump to become president for 4 more years. There is a significant and very large contingent of investors who have an unshakable faith in Trump's judgment, notwithstanding the many well documented episodes in his personal financial history that highlight a lack of judgment, and believe that his policies will be beneficial to the U.S. economy. On the margins, however, there are those who are waiting to see whether disasters start to unfold. And there is push and pull between these two camps now. I am in the latter camp. One cause of these increasing bouts of anxiety is just the uncertainty of whether President Trump will actually do what he said he would do upon becoming president again. Will he start a trade war by implementing significant tariff increases on a broad range of imports? Will he start the mass deportations of undocumented U.S. consumers, many of whom perform jobs vital to the supply chain, particularly in the agricultural sector? And will he and his Republican allies in Congress slash hundreds of billions of dollars of federal spending on domestic programs? What is clear is that there has been no analysis of the negative implications for each of those policies, or at least an analysis that Republicans have disclosed and discussed with those who voted for them in the last election. No country will win a trade war. Perhaps the lessons have been forgotten about past trade wars. And I think that's reflected in the fact that a vast majority of Republicans support across the board tariff increases on imports, according to recent polls. They are apparently unaware that the import tariffs are taxes that they will pay. And many of them do not pay federal income taxes at all, but they will be paying the tariff tax. Even when history is in a recent memory, far too many people failed to learn from the reality of what actually happened and why. A recent example is what actually caused the recent problematic inflation and how the Fed contributed to it by keeping the extremely expansionary monetary policies known as QE and ZIRP until March 2022, when CPI had risen to an 8.5% increase over the prior 12 months. The inflation fighting credentials of this Federal Reserve is more than just a little bit suspect now, and that may be contributing to the 100 basis point increase in the 10-year Treasury yield starting in September, when the Fed cut the federal funds rate by 50 basis points. With two subsequent 25 basis points cuts in the federal funds rate, short rates have come down 100 basis points or so. So there's symmetry, at least, in that the 10-year Treasury yield over that same period has risen 100 basis points since the rate cutting cycle began. So the recent memory of how the Fed responded to the last rise in inflation is still very well known to bond investors and knowledgeable stock investors. The lessons from long ago history have been forgotten, like what happened in 1930 when Hoover and the Republicans in Congress passed the Smoot-Hawley Tariff Act of 1930 that increased tariffs across the board. And that was a major cause of the Great Depression. Is Trump even aware of that history? He gives no indication that he is. The tariff increases that Trump has proposed and the mass deportations will result in supply chain disruptions if they're actually implemented. Have we already forgotten that the supply chain disruptions resulting from the pandemic and its aftermath was a major cause of the problematic inflation experienced for about 2 years in 2021 and 2022? And if Trump carries through with his tax cut proposals, which included, as I recall, no tax on tips, no tax on overtime, no tax on Social Security benefits, and there are some others. The tax cuts, if implemented, will fuel increase in consumer demand when supply chains are being disrupted by these other policies, if implemented. And that will add fuel to the inflation fire. As to massive cuts in federal spending, there is no doubt in my mind that the U.S. faces a very serious long-term fiscal crisis that needs to be addressed with a balanced approach involving relatively slow revenue increases and spending cuts. The problem now is that the U.S. economy is far too dependent on the government running budget deficits over $1 trillion annually. The budget deficit for the fiscal year ending September 30, 2024 was $1.8 trillion, and that occurred during a period when inflation was in a steep decline. So did the excess of spending, and it clearly is excessive in my opinion, add to inflation during that fiscal year? Spending $1 trillion plus of borrowed money annually will spur GDP growth, which has been the case for consumer spending, which has been on a parabolic increase of spending borrowed money in what I call the age of leverage that started in the early 1980s. So a lot of the U.S. GDP growth is dependent on both consumers and government spending more and more borrowed money. If too much federal deficit spending is withdrawn too quickly, the risk is that the economy will sink into a recession for that reason alone, without any contributing factors like a tariff war, the mass deportation of undocumented U.S. consumers, and the continued rise in intermediate and long-term interest rates that have been in an upward trajectory since the Fed started to cut short-term rates. So for policy makers, the risks need to be understood and carefully taken into consideration, which is not something that Trump is capable of doing, in my opinion. And there's no one in his orbit now capable of restraining him from taking actions that will have far-reaching negative implications for the U.S. economy and for most of many of the, particularly the rural voters who were responsible for giving him a second term in office. I do not expect stock and bond investors to react well to Trump actually doing what he said he would do. For now, those are just concerns about the future rather than a reality that investors must confront when Trump actually starts to do what he said he would do. I am responding with my investment portfolio by becoming even more super cautious, and my nature is to be extremely conservative. And basically putting my capital preservation objective on steroids here. I'm basically in a wait and see mood to see what actually happens in early 2025. My stock portfolio is at less than 10% of my total assets and brokerage accounts, and I'm very liquid to take advantage of whatever opportunities may arise, which was also the case in February and March of 2009. About one half of my Vanguard account is in the uh, Vanguard money market fund, which has the highest yield of all the money market funds in my four brokerage accounts. And my other accounts have almost a daily stream of proceeds from maturing Treasury bills, CDs, and short-term corporate bonds. I have started to buy, nibbling may be a better description, and Treasury notes maturing in the 2027 to 2033 timeframe, which I will be discussing in my next blog, which will be posted next Thursday. The YTMs of those purchases are close to 4.5% with coupons 4% or better. I will be discussing those purchases in my next blog. I'm buying about $10,000 to $20,000 a week in Treasury bills, over $10,000 in short-term corporate bonds. But even with the corporate bonds, I'm starting to extend my maturity sum into 2027 as the yields become more attractive compared to the short-term yields that are available in Treasury bills now.